Okay, I think we'll get going. We've got most of the delegates here. So, good morning, everybody, and welcome to this seminar, a step-by-step guide to selling your business. I'm Jaslin Bhagrath, and I head up the Accounting and Business Solutions team here at Henderson Loggie. I've worked with many businesses over the years who have built up a successful business, but don't always have a plan for exit. And there are plenty of things to consider when considering your succession plan. A proper strategy and planning is key. In this morning's session, I am joined by a panel of experts who will be talking us through the financial, legal, and tax aspects as you think about selling your business. So first of all, let's meet the panel. Today, I am joined by Rod Mathers, Corporate Finance Partner at Henderson Loggie. Rod has advised many businesses over the years on their succession plans and has also worked with them to help them achieve their growth ambitions through acquisition and capital growth. I'm also joined by Dawn MacDougall, Tax Director at Henderson Loggie. Dawn specialises in providing complex tax advice to owner-managed businesses at all stages of their life cycle, from startup to exit, and frequently advises clients on all aspects of succession and inheritance tax planning. And I'm also delighted to be joined by April Bingham, Head of Corporate at Bellwether Green. April guides businesses through the legal aspects of acquisition, sale, and investment. The seminar today should last around 45 minutes, and then there'll be plenty of time for Q&A at the end. So please do use the chat function to drop in any questions that you have, and I will ask the panelists at the end. So let's get started. So Rod, coming to you first, obviously the pandemic has been challenging for many businesses, but also for others, they have really thrived. Whoever's looking to sell their business at the moment, what is the current landscape looking like?
Yeah, thanks, Jaslin, and good morning, everyone. I head up the corporate finance team at Henderson Loggie, and looking forward to our session this morning in succession planning. And yeah, it'd be good just to set the scene, give you my views on the current landscape for selling businesses at the moment and some of the key trends. I think everyone agrees that it's been quite challenging over the last 18 months, 2 years due to COVID. Actually, the market for mergers and acquisitions is actually quite buoyant at the moment and has been for a wee while. And I think there's a number of reasons for this. Firstly, understandably, many sale processes were stopped or paused back in the first quarter of 2020. But for those businesses that managed to navigate their way through the COVID issues, many business owners are actually revisiting the process and actually thinking about selling the business now. Companies in certain sectors actually did very well throughout the pandemic, particularly those with a technology or a healthcare focus. And these businesses could be attractive now as they give buyers a competitive advantage, and in some cases allows them to disrupt the market in some way. And I think that's a key buzzword at the moment in M&A, disrupting the market. Private equity buyers are no exception, and much of the M&A activity at the moment is driven by private equity. There's a lot of committed but unallocated capital at the moment. That's unspent cash waiting to be invested, and that's sometimes known as dry powder. But private equity are very active in the market just now. On the debt front, mainstream banks continue to be cautious, but there's a number of secondary lenders who are keen to support good businesses and support their growth plans. In terms of valuation, there's no surprise that valuations took a dip from March 20 and through most of last year. However, deal multiples seem to be climbing back up again, and I think they're back now to level enjoyed prior to the pandemic. Obviously depends on the sector, of course. So finally, tax environment remains positive for businesses, business and company sales. you'll all be familiar with the business asset disposal relief, which continues to be available at 10%, a 10% tax rate for qualifying businesses, up to £1 million of lifetime gains. And Don will maybe go into that in a bit more detail later on. And there's been quite a lot of speculation that the Chancellor is going to increase capital gains tax rates. This hasn't happened yet, but it did mean that there was a spike in company disposals prior to the March 21 budget. So I think in summary, there's some positive trends in certain sectors. Valuations are back to where they were before. And the environment for deals is actually generally quite good for quality businesses. So probably not a bad time to test the market.
Okay, thanks, Rod. So you've advised many business owners over the years on selling their business. In your experience, is it ever too early to start planning? And what would you advise business owners if they are considering a sale?
Yeah, I have advised on a number of transactions over the years, and you can confidently say that no two situations are the same. One common theme is planning. In my view, it's never too early to start planning. Dawn in April will cover the tax and legal aspects of planning for a sale. In my experience, there's a step well in advance of that, and that's planning your succession, which could be many years in advance of any transaction. It's really important to be clear on the strategy for your business during this period and make sure it's aligned with your succession plan. It's also important that you're clear on your own personal objectives and that they're also aligned. So, for example, if your ideal exit is to sell to a trade buyer and you want to maximise value, then you may wish to adopt a strategic plan that involves growth with possibly investment to fund this growth. And it may also involve refocusing your product or service offering to attract a higher value. I'm working with a company at the moment, which is a good example of this. Historically, they mainly provided consulting services. However, through time, they've transitioned into a reseller of products, and they provide value-added services on the back of these products. And the majority of their revenue is now recurring in nature, and they have generally 1 to 3 year contracts. So that no doubt means that the multiple that they'll get for their business is much higher than it would have been as a consulting business. Often, best sales in my experience are those where there's an existing relationship between the buyer and the seller. And you may want to, as part of your succession plan, specifically align yourself with a particular buyer. Another good example of this was a business that I advised on a couple of years ago. It was a packaging business, and they had developed a particular technology for one of their customers. This led to discussions around how they could work together more closely, and it ultimately led in a successful sale, and quite a straightforward sale, because the relationship was there. So bringing management with you in this journey is really important, and you may wish to incentivize them in some way through share options or other incentives. And again, Dawn will touch on that later. However, sometimes maximizing value may not be your principal objective. The business owner may have made as much money as they need to fund their retirement, but their kind of principal concern and focus is on ensuring that the long-term security for their business and employees that they maybe worked with for years and years and are very loyal to. So this situation may lend itself to a management buyout or employee buyout, where the purchase price consists mainly of surplus cash in the company and also deferred consideration. And there's a lot of these transactions happening at the moment. The advantage of this approach is that you don't have to go through a lengthy marketing and due diligence process and run the risk of providing information to potential competitors should the deal not go ahead. The key here again, however, is management. I think that's a common theme. If an MBO or employee ownership structure is being considered, you need to make sure that they're fully bought into the process early on, such that when the deal's ready to happen, there are no surprises.
Thanks, Rod. So Dawn, obviously, Rod has talked there about planning in terms of finances, but I know that tax is obviously a really important element when it comes to selling your business. What are the key areas to think about from a tax planning perspective when considering a sale?
Thanks, Jaslin. So good morning, everybody. So Rod has gone through some of the ways in which you can sell your business. And I think one of the most important things from a business owner's perspective is to plan well ahead and decide what sort of format the sale will take to ensure there are no surprises in terms of the amount of tax that will be payable on an exit. And you'd be really surprised at the number of people who actually are at the stage of exchanging heads of terms who haven't taken any tax advice. So who you sell your business to and what you sell and whether it's a share sale or an asset sale can all have a significant impact on the final tax bill. I'm now just going to have a look at a few common types of scenarios which are frequently used to structure a sale. So a fairly straightforward one is to gift shares in your family company to other family members who are going to remain in the business. If you have a trading company, and that's one where the income, asset base and time spent by employees is substantially trading, then it is possible to gift shares to family members, pass on your base cost and defer any tax liability. And one of the key things to bear in mind here is that the person exiting the business won't be getting any consideration for their shares because it's a gift. So it is important to ensure they have the means to fund their retirement. In terms of a company purchase of own shares, this can be a tax efficient means of extracting cash for a retiring shareholder. Obviously, certain conditions have to be met and HMRC clearance obtained, and that should enable an exiting shareholder to have their shares bought back from the company. The shareholder would get cash to fund their retirement, and the funds received by the shareholder should be taxed at the lower capital rates rather than the dividend or income tax rates. But please bear in mind, there would need to be sufficient cash in the company and also distributable reserves to fund the buyback. A common question I often get asked is, should a shareholder sell the shares in his company or the assets out of the company? In my experience, a vendor will normally want to sell their shares. And this is because, as Rod indicated, business asset disposal relief may be available. And if the vendor's gain is less than £1 million, the gain will be taxed at 10%. And this can be a really valuable relief. And it is important to ensure that the shareholdings are structured to take full advantage of this. For BADR to apply, there has to be a sale of the shares in a trading company. And for a period of 2 years prior to the sale, the vendor must own 5% of the nominal value of the voting shares. And they also have to be an officer or employee of the company. So it is important to continually review your accounts to ensure the company is substantially trading. And items such as high cash balances and investment properties can taint the trading status of a company. You can consider transferring shares to other family members working in the business, so they can take full advantage of their £1 million limit. But do remember, they have to be an employee or officer of the company, so don't forget to give them that crucial role. And remember also the requirement to hold 5% of the nominal value of the shares for a period of 2 years. So for argument's sake, if say a husband wanted to give some shares to his wife and she owns 4% before the transfer, then just bear in mind that she will have to wait a further 2-year period to be able to make a BADR claim on the total shareholding. And just returning a minute to the asset sale, whereas an individual selling their shares can get a 10% tax rate or at worst a 20% rate. If there is an asset sale, then all the chargeable assets, goodwill and land and buildings being the most common, there will be a tax charge in the company, and that would be currently at the corporation tax rate of 19%. And then there will be another layer of tax, which will be charged on the extraction of the proceeds at the shareholder level. And once again, This does need careful consideration to ensure the owner of the business can extract capital gains tax rates rather than the higher income tax or dividend rates. Another point which should be considered well in advance of a sale is any assets in the company which the vendor may wish to retain. So for example, a purchaser might not want an investment property or an office block used by the company, and it may be that the vendor plans to use these assets as part of their pension provision. So it is possible to extract these assets just before a business disposal, and in that instance, the shareholder will pay tax at dividend rates, and the company will pay tax on any gains. However, please note, with a bit of planning, it can be possible to pay no shareholder and no company tax if an asset split is undertaken under the demerger provisions. So planning is really important, as this can take a bit of time, and it is also necessary to obtain HMRC clearances, but it can save quite a lot of tax. Rod also mentioned employee ownership as a means of the business owner who is not necessarily looking for a third-party buyer to sell to the employees of the business. And subject to certain conditions, the shares can be sold without incurring any tax charge arising on the vendor. And also, as Rod indicated, it is really important to ensure that there is employee engagement with this type of arrangements, and also that there is a robust management structure in place to ensure the continued smooth running of the company, particularly as some of your consideration is likely to be deferred. So it is important to ensure the trading position of the company is maintained. And it is also worth thinking about inheritance tax at this stage in the process. So if the vendor holds shares in a trading company, the shares should qualify for inheritance tax relief, which means if the shareholder were to die suddenly, the value of their shares will be protected from inheritance tax. If there is an exit and the shares are sold for cash, then the cash will be chargeable to inheritance tax at 40% in the event of the shareholder's untimely death. It is possible to transfer some shares into a discretionary trust, which will mean that once the shares are converted into cash, and also subject to the donor shareholder surviving 7 years from the date of the gift, the cash will remain out of the shareholder's estate for inheritance tax purposes. If the shareholder was looking to move some shares into a trust, we would strongly recommend a review is undertaken to ensure that inheritance tax relief will apply on the transfer of the shares into the trust. And please also bear in mind that trustees of a discretionary trust can't claim BADR. However, that will need to be weighed up with the inheritance tax saving of moving assets out of the shareholder's estate. Another question I often get asked is about retaining and incentivising staff in the run-up to an exit event, and EMI share options, which are used in small and medium-sized companies, can be very tax efficient. There's normally no tax to pay when the options are granted, and the employee will only pay tax when the options are exercised, which can coincide with an exit event. The employee will pay tax at capital gains tax rates, and provided they have held the option for a period of 2 years, they can qualify for BADR on the sale of the shares on exercise of the option. So it is a really tax efficient way of giving shares to employees. So in summary, timing is crucial when planning for a sale, and please do take advice to maximise reliefs and minimise the amount of tax which can be due on an exit.
Thanks, Dawn. So I suppose, April, coming to you now, I know that it's critical for business owners to get their house in order before a sale. What do business owners need to think about from a legal perspective just before they kickstart that sale process?
Thanks, Jaslin. What they have to think about from a legal point of view is often at the early stages more to do with project management and timing. One thing that Dawn touched on was the idea of moving shares around among the shareholders to get the best possible tax outcome. The other thing you have to think about in relation to shareholders is, what are the ongoing relationships among the shareholders? Is there someone sitting with a minority stake in a company, if a company sale is what's being considered? Is that person potentially going to be difficult? Are they likely to go along with plans for a sale of the company? Or do you maybe need to look at buying them out early so that you've got the freedom to do what you like with the company? Sometimes there are provisions in a company's articles of association which allow a majority to quite literally drag a minority shareholder into a sales situation. But to be honest, having seen that implemented, it's a very blunt instrument, and it's much better to either have an aligned group of selling shareholders or at least have dealt with any problematic shareholders in advance. So I would just say, have a think about any political problems among shareholders, or have discussions well in advance about the ideas you have for exit, particularly with minority shareholders. Even if they're not likely to be difficult, even if they're investors, they'll be extremely interested to know what the plan is and what their role will be in the sale of the company. Again, Dawn touched on assets and potential for extracting assets such as cars or buildings that you might want to hang on to, even if you part ways with your business or your company. The other way of looking at it is are things that you've been relying on or using informally for the business or the company that are actually in your own name as a founder or an owner manager of the business. So things to think about there are intellectual property, website domain names is a common one. Sometimes even properties that are very informal arrangements to use properties that are actually owned out with, for instance, a company. It may be necessary to put a formal footing in place to allow the company some kind of basis for occupation. Really, the way to look at it is, what would a buyer be interested in? What bundle of rights and properties and stock or machinery would they need to pick up the business from the current ownership and run it successfully straight away afterwards? And so making sure that all these assets are where a buyer might expect to find them, or that they're in some way linked formally to the business that can be passed over to the buyer. I think that's quite an important planning point. Both Rod and Dawn have talked about the importance of incentivizing and getting management teams on board. And I won't go over that again, but I would just echo what Dawn said about the timing of, for instance, putting share option arrangements in place. That takes some time, and certainly the sooner that you can put that in place before a sale, the more likely the key employees are to benefit from those option arrangements, because presumably if, for instance, you put them in place 4 years before a sale, the value of the company will increase over that 4-year period, and they stand to make a much more beneficial gain on the value of the shares that they have options over. Is IPR protected? Again, a seller may well look for trademarks, for patents, and I'm sure if you're in a business which is tech heavy, and Rod talked about how busy things have been in the tech sector just now, then you're likely to be well ahead on protecting your intellectual property. But it's worth, I would suggest, doing some kind of audit to see if there are actually trademarks, design rights, copyright material, items that you take for granted and use within your business, or indeed items that you use on an informal basis and don't have a long-term or formal license agreement to use. I would make sure that you've got the rights to use what you're using, and any rights which you own are protected with registration if possible, just to make you as appealing as possible to a buyer. On the subject of auditing what you have, again, a health check on your contracts, your commercial contracts. You may have dealt with the same suppliers and the same customers for many years, year in, year out, without a hiccup. But a buyer coming into due diligence on your business or your company is going to be looking very closely for default provisions, for limitations of liability, for the ability to assign those contracts if necessary. And certainly they'll be wanting to see the basis of the long-term nature of those contracts. So for instance, is each contract for a fixed term of 5 years? If so, are we close to the end of that 5 years? Are there about to be new commercial contracts negotiations required? Do the contracts roll on a year-to-year basis? A buyer is going to be very interested in all of these aspects to work out whether or not they can depend on a certain revenue stream relative to a contract with a customer, or to know whether they can depend on a supplier contract if there are opposite customer contracts that need to be fulfilled. Similarly, compliance, health check. You know, if you're a regulated business, perhaps with the FCA or other care inspectorate, other quasi-governmental bodies, then you're going to want to make sure that your business is as highly polished as it can be, looking good in terms of reporting standards and compliance measures, because all of these things, believe me, will be crawled over during a diligence process by a potential buyer, and you don't want to find an unexpected issue. Unfortunately, unexpected issues do come up regularly. If you can avoid it, then that puts you in the best possible position from a negotiating point of view further on in the deal process. Think about whether you need any kind of third-party consents. An obvious one might be a bank consent. You may have securities over your company for bank borrowing, or indeed your business and assets if it's a business sale. You might need the bank's consent to proceed with a sale. You might even need them to discharge various debts and securities. And so you'll need to start a conversation with them in plenty of time to prime them for that potential change of control, and to make sure that you can produce any assurances that the buyer will ask for in time for completion. Books and records, again, fall into a similar category. If you've got everything in a well-ordered, easily presentable format, then that's so much the better. Nowadays, due diligence is conducted almost entirely online using data rooms, and so having all of your books and records in an electronic format is extremely helpful. And I appreciate that for some businesses who've never needed to do that, from a trading perspective, it can be quite a daunting thought, getting all of these things scanned, put into electronic format. And so, it's probably worth starting doing that with some basics like insurance documents, employment documents, and of course your financial documents quite early on.
Thanks, April. So lots to think about there, even before we start the sales process, and it is important that we get everything in place. So hopefully now, if you're thinking about a sale, you've put all your tax, legal and financial points in place, and now is the time to start the sales process. Rod, what's involved in the sort of practical aspects of a sale process, and what advice would you give to business owners who are about to embark on this journey?
Yeah, thanks, Jaslin. I think the most important thing about a sales process is to make sure that you control it throughout. It's very easy for the process to control you, and that's something you want to avoid if at all possible. I think the second most important thing about a sale process is very much linked to my first point, and that is appoint good financial and legal advisors. And I would say that, but I think it's really important. If we do our job properly, then we can manage the process for you, allowing you to run the business during a very critical time. Particularly important that you continue to do well during a sale process, and you meet and exceed expectations. So allowing your advisors to take as much off your plate as possible, I think, is a good thing. If maximising value is your objective, you may want to highlight any non-trading, exceptional or one-off costs to ensure that you accurately represent the true underlying trading profitability of the business. April talked talked to Ella about making sure your contracts are in place and all books and records are up to date. I think before you actively engage with buyers, as April said, you should store all this information in one place in a data room. More often than not, it's something that your legal advisor will ultimately control, as it's very much linked to the warranty and the disclosure process, which April will talk to later on. So often business owners know who the likely buyers are for their business, as they know more about the business and the markets that they operate in better than anyone else. However, we as advisors are often aware of who's buying businesses, what the market's doing, what the trends are in certain sectors, and we can reach out to our networks to identify buyers that maybe business owners aren't aware of, some left field buyers. So it's important that you do your homework on anyone that you're thinking about approaching to sell to, and it's appropriate to speak to them. So alongside the process of identifying buyers, you and your advisor should be preparing an information memorandum, or at least an information pack to provide to the buyers. But before you do, make sure you put a non-disclosure letter in place. So this information memorandum, together with perhaps a meeting with the sellers, this should give the buyers enough information to allow them to make a proposal or an offer letter for the business or the company. So ideally, you'll have more than one interested party, and at that point you can run an auction process to maximise value. I would highlight that achieving the best price is not always the most important criteria for selecting a preferred buyer. Other considerations could include confidence of the buyer delivering the deal, confidence over actually receiving any deferred consideration or earn-out payment that's built into the structure, speed of execution, or it might be that the business owner just wants to sell to one party in particular due to an existing relationship or based on their plans for the business going forward. So up until that point, it's really important you keep track of all the information that you've provided to each of the potential buyers, and even what you said to them during the process. It's also really important that you can back up any information that you've provided or statements made, as a buyer will go into a lot more detail in due diligence. For example, if you make a statement or include some financial analysis in the information memorandum, you need to have this detail that sits behind it. And going back to what I said earlier, it's a good example of you keeping control of the process. So once you've selected your preferred buyer, the next stage is agreeing heads of terms, the due diligence process and negotiation of the legal contracts, which April will now cover.
Thanks, Rod. So April, Rod's obviously now found a buyer, and we've got a price that is acceptable to the seller. Can you just talk us through the next steps in terms of the legal contracts, the warranties, and the disclosure issues to consider?
Sure. Yeah, thanks, Jaslin. I guess heads of terms is probably the most likely point of contact with lawyers, and this where we usually get wheeled in. Usually a very capable corporate finance accountant like Rod has been involved in the negotiations to a point where the preferred buyer is found, as you said, Jaslin, and we're then asked to review heads of terms, which will contain the commercial points of the deal, which you'll have negotiated with the buyer already, but they'll also touch on what is likely to form the basis of the share purchase agreement. So for instance, the heads of terms may discuss some of the limitations that will apply to warranties and indemnities in the deal to come, and I'll explain that in just a moment. But most heads of terms documents are non-binding, and so whilst they are very helpful for the parties, particularly as the deal progresses and everyone gets perhaps entrenched in points and needs to get back to basics and what did we agree at the beginning, they're very helpful from that point of view, and they're very helpful to inform lawyers to draft the share purchase agreement. There is one or two aspects which do tend to be legally binding, and those are confidentiality and exclusivity. Now, if all's gone well, you've got a non-disclosure agreement in place in relation to the data room that Rod or someone like him has helped you to prepare. and perhaps your legal advisors have helped you to prepare that as well. It may be worth revisiting the terms of confidentiality protection that you have. You know, there's going to have been an element of presenting what information you want to present to the buyer so far, and you know, at this point it's really a pivotal moment. The buyer's really going to want to get into the nitty-gritty of your commercially sensitive information, and so you might at that stage enhance the confidentiality obligations that you're looking for from the buyer. And it's not uncommon at all for a buyer to say, look, we're about to incur a great deal of costs and expense carrying out a diligence process, instructing our lawyers to do drafting of the share purchase agreement. We'd like to have some exclusivity. We'd like to know that we're the only buyer you're talking to. And if that's something you're going to afford the buyer, then that kind of agreement would normally be housed in a heads of terms. And you need to think probably in advance about your openness to that kind of provision, and how you would feel about a buyer asking you, for instance, if you breach the exclusivity undertaking, to contribute to their legal costs, or indeed absorb their legal costs because you've broken the exclusivity agreement. Sometimes there are fixed penalties imposed, like a one-off payment of £10,000 or something like that. But it's worth just thinking about how far are you willing to go in terms of giving a buyer comfort that they're the only person you're talking to, and how long would you be willing to entertain that exclusivity. Diligence, hopefully by the time we move on to diligence, where the buyer will issue a very detailed diligence questionnaire, both on finance and both on legal aspects, you should be in relatively good shape if you've managed to sort of follow the path that we've been setting out here. It's really important nowadays more than ever that you do communicate with your legal advisor about all the information that you're providing in response to diligence questions. And that reasoning becomes more important. On my next slide, I'll discuss warranties and disclosure. It's helpful to have a very ordered diligence bundle or data room set of documents which are inventorized and up to date and kept up to date throughout the deal process, because you're going to come to rely on those documents and your answers to diligence questions in order to limit your liability under warranties, which you'll be asked to give. And it used to be the case that a seller could more or less say to a buyer, look, anything I tell you about the company will be a disclosure. And buyers are getting much pickier. There's a trend emerging with buyers saying, no, you must very specifically point us to disclosures within the diligence information, line by line almost, and tell us which parts of the diligence information or your responses will become disclosures, which is a painstaking process and can only be made easier by an orderly, coordinated approach across advisors and client. So the main deal document, if we're talking about a company sale here, is the share purchase agreement. And similarly, if it's an asset deal, then it'll be a business purchase agreement. But I'll run through the main aspects of a share purchase agreement, and you can assume that they'll be relatively similar in a business purchase agreement, albeit there's a purchase of business and assets rather than shares. Probably the most important clause to be covered off for the buyer, the seller rather, is the consideration clause. And there's much to be thought about consideration. And by the time you get to heads of terms, you should be broadly agreed with the buyer about certainly the amount of consideration, or if the exact amount isn't known, how it will be calculated and when the consideration will be payable. It's not uncommon at all, regardless of the type of buyer, to have deferred consideration payable. So for instance, let's say, for talking sake, 50% of the total price might be received by the sellers on completion, the day that they release control, hand over control, and then the other 50% may be paid over the next 2 years, maybe in annual installments or quarterly installments. And if you're going to accommodate that kind of price structuring, then the first port of call is security. if you're a seller and you're allowing someone time to pay, it's just like any other credit scenario, especially if it's a lot of money, it could be millions of pounds. You need to have some comfort that you're going to have the necessary teeth to enforce the debt that is payable to you. And if at all possible, you'd want to achieve secured creditor status. So that might involve taking floating charges over the company that you're selling and the buyer's company and any other parts of its group that are relevant. Or for instance, if the buyer has set up a new special purpose company to make this acquisition, you're going to look for guarantees from the buyer company that actually has all the assets, so perhaps a parent company guarantee. You might look for personal guarantees if you're selling to a management buyout team. There are a myriad of securities that you could look for, but at this stage I just want to flag that it's your primary concern to work out how you can achieve some kind of comfort and security if you are going to consider giving a buyer time to pay. Earnouts are a kind of mechanism that comes up regularly where owner managers are in a sector which involves advice or is somehow tied to perhaps the sales performance of the owner manager. An earnout will be there to deal with the potential of the owner manager staying with the business, having sold, but increasing revenue or increasing sales over, say, the next 1 or 2 years post completion. They stand to gain some upside if the company meets a certain EBITDA target or meets a revenue target, then the price may stand to go up if they meet those targets, or the price may stand to go down if they fail to meet those targets. And the drafting for earnout provisions is notoriously tricky, technical and complicated. That's partly because we on the one hand want to protect all of the moving parts of the business that might affect how well or otherwise the owner manager can achieve those targets, but also because there are complex tax provisions around earnout consideration qualifying for business asset disposal relief that Dawn was talking about earlier. So if you're in a sector where you're asked to consider an earnout as part of the price mechanism, it's worth really having a good discussion with that about both the tax side and the technical implications with your range of advisors. Completion accounts are, or locked box mechanisms are there. They're a significant part of the share purchase agreement. They're there because on any given day lined up for completion, a company will have incomings and outgoings, and no one can know in advance exactly what money will be owed, what money will be in the bank account. They can take a really good estimate, but they can't crystallize time in advance. And so completion accounts process or lockbox process looks at a certain date in time, and a new set of accounts for that date and time will be prepared in terms of the provisions set out in the share purchase agreement to determine whether there was, for instance, any surplus cash in the company at the time it was bought and whether that should be paid over to the seller, or to determine whether in fact there's a certain amount of working capital required for that company and it was in a deficit at the time of sale, and so the buyer might be asked to contribute to that deficit. I won't go into any more detail on it just now because that could be a seminar in itself, as could warranties and indemnities, to be honest, but I'll try and give you a kind of flavour of how warranties, indemnities and disclosure work. I don't know if anyone on the call is aged enough to remember buying a car. I certainly am. Buying a car from, a second-hand car from a newspaper ad. And I always remember my dad telling me, oh, it's buyer beware, you better check that car thoroughly, make sure it's okay before you drive away. In selling a company or a business, the converse is true. It's incumbent on the seller to disclose and reveal warts and all the issues that their company or business has. And the reason that they would want to do that during the deal process is because the buyer is going to look for 40 pages or so of warranties. And those warranties are each a sentence which is a guarantee of fact about the company. So for instance, the number of employees disclosed, that's all the employees of the company. None of those employees are on long-term sick. None of those employees have raised a claim against the company. None of those employees have a grievance. You know, each warranty incrementally adds to the pressure on a seller to tell the buyer if something contrary is true. If the seller does reveal, for instance, in that example given, well, actually we do have an employee tribunal claim running just now, it's for someone that left, they were a bit aggrieved about the way they were dismissed, we think we'll win, but you know, it's the tribunal date's coming up post completion, then a buyer might look for an indemnity. That's an undertaking from the seller to make good any loss suffered by the buyer for a known risk. So the known risk here is there might be an award made to that employee. We know the award might be up to £50,000. So the buyer might ask the seller, look, if we end up having to pay £50,000 to that employee, it's all to do with what happened on your watch. So we want you to reimburse us for £50,000 if that's the case. And that sounds like quite an impalatable prospect to a lot of sailors, but it is the way that risk is allocated and apportioned. The other way of apportioning unknown risk is via the warranties. And so having asked for the 40 pages or so of statements about the company, it's inevitable that all of those statements will need to be reviewed and a significant number of them qualified. And the way of qualifying those statements is to disclose against them. And that's where this perfectly formed bundle of diligence information and well-tracked diligence responses that I talked about earlier should come into play. So we should be able to very easily reference documents, responses, and items that we've already made the seller aware of in relation to those warranties. So taking, for instance, the employee example, we would disclose all of the tribunal proceedings papers, that employee's employment contract, any correspondence between the company and that employee detailing the employee's claim, so that all of the information is readily available. And apart from the indemnity that's been asked for, there won't be any other breaches of warranty. You know, there will be wider warranties. They'll say, for instance, there's no ongoing litigation. Well, it wouldn't be a breach of that warranty in relation to that employee claim because we've disclosed against it. So disclosure is the main way of limiting liability under warranties. The other way is to impose certain contractual limitations. So for instance, monetary limits or caps, and there are some conventions around which would be applied. And the other is to impose time limits. So for instance, you might say to a buyer, look, I can only for a certain amount of time tolerate the idea of you coming back to me for some kind of reimbursement or claim under a warranty. And so a seller might typically agree to give 18 months or 2 years post-completion period during which the buyer can approach them for a warranty claim. And, you know, just to put that in perspective, in 20 years of practice, I've seen maybe 2 deals where there have been warranty claims. So it's something to be taken seriously. It is significant, but you know, you have to put into perspective a lot of commercial reasons why buyers want their warranty protections, but might be put off making warranty claims that go all the way to court. Sometimes they'll have a try and make them, and a negotiation ensues and it gets dealt with. But actual court situations following for warranty claims, as I say, I've only seen twice. Tax covenants are similar. They are a form of indemnity. It's essentially the seller agreeing to reimburse the seller for any tax liability, reimburse the buyer for any tax liability relative to the seller's period of control and ownership. Tax covenants, unfortunately, and tax indemnity, tax warranties tend to last for 7 years, which is sounds very daunting and like a long period of time, but it's because HMRC can look back that period of time on investigations, and so it's absolutely standard to grant those for that period of time. And the last point I would mention that you'll see in most share purchase agreements is restrictive covenants, and by that I mean non-compete clauses. So obviously a buyer buying a company would want seller to promise that they won't go and set up in competition with their former company immediately after completion or after their period of handover or earn out or whenever they finish affiliation with the company. The restrictive covenants will protect the buyer for, I would say, typically a period of about 3 years, although 5 years is probably the maximum period that a buyer could enforce. And they're not to be confused with employee restrictive covenants, which are much harder to enforce and tend to last a much shorter period of time, like 6 months or 12 months. Share purchase agreement restrictive covenants will be likely enforceable and for quite a few more years. So it's worth bearing in mind, particularly if your sale is not, you heading off into the sunset for complete retirement. If you want to do other work, worth bearing in mind that you might be restricted by the buyer.
Thanks, April. So Dawn, obviously April talked about the different types of sale considerations, and I just wondered if you could kind of touch on the tax implications of these.
Yes, of course. So in terms of consideration, as April has explained, the seller can receive different forms of consideration, and each has different tax consequences. And very often there will be a transaction where the seller will receive a combination of different forms of consideration. So if, for example, a seller is selling their shares in return for immediate cash consideration, then the date in the SPA will become the date the contract becomes unconditional, and the tax will be payable on the 31st of January, following the end of the tax year in which the sale takes place. It can become more complicated if there is an element of an earn-out, as April mentioned. If the earn-out is ascertainable, so it's a defined amount payable over, for example, a 3-year period, then the shareholder will pay tax on the normal consideration plus the ascertainable earn-out upfront. And please note that there is an instalment option where the taxpayer is suffering financial hardship because he's got to pay the tax upfront. If, on the other hand, the consideration is unascertainable, so it cannot be calculated with absolute certainty because it's dependent on some future event, for example, future profits which have to reach a set hurdle amount, then this right to receive unascertainable deferred consideration is treated as part of the consideration. So the seller will then have to estimate the present value of the right to receive the future payment of consideration, and that will be added to any other proceeds and taxed at the time of disposal. And then any future amounts of deferred consideration will then be taxed at the time the consideration is received at the prevailing rate of capital gains tax. The main difficulties with unascertainable consideration is determining the value, which will be subject to capital gains tax, and also whether business asset disposal relief will apply. This is really, this can be a really tricky issue, and whereas BADR can normally be claimed when the consideration is brought into account up front, it won't apply to the receipt of future amounts of consideration as you're disposing of a right, not share capital. So it is important to consider the valuation of the earn-out carefully and to consider how much can feasibly be taxed upfront to ensure that the benefit of business asset disposal relief can be maximised. Additionally, a robust valuation will mean we can defend against an HMRC inquiry into the value of the unascertainable consideration. If circumstances permit, it could be possible to change the structure of the earn-out to bring forward the tax liability on the full value of the earn-out, and that would permit the seller to claim business asset disposal relief and pay capital gains tax at the current rates. And if, as we are led to believe, there's going to be an increase in capital gains tax rates, then this is definitely something to consider. And please note that where consideration which was deferred becomes irrecoverable, the shareholder can make a claim via their self-assessment tax return to obtain a repayment of tax. So moving on to shares and loan notes. So paying cash for a business can be high risk, and purchasers may opt for payment of shares or loan notes. Where shares or loan notes are given in exchange for a sale of shares, the gain can be deferred by the vendor, assuming the share for share exchange conditions are met. One point to note here is that the share for share exchange must be for bona fide commercial reasons. So it is important that the decision to opt for loan notes is driven by the purchaser. When the shares are exchanged for shares in another company, a key consideration will be whether business asset disposal relief will be available on a future disposal of shares. And it is likely on a future disposal, all the relevant conditions won't apply. So the shareholder may not hold office in the company, may not own 5% of the shares, so business asset disposal relief won't be available. And in this instance, it is possible to make an election upfront, and that can be made to disapply the share for share rules. So all the tax is payable upfront, and a claim for BADR can be made on the full amount. So definitely something to think about. One point to make, if the shares are being exchanged for loan notes, is the distinction between QCBs, that's qualifying corporate bonds, and non-QCBs. Now, this is a topic worthy of its own webinar, and I just really wanted to flag this is an issue to consider when structuring a sale. So a non-QCB is the same as a share or a security, which means there is a possibility that business asset disposal relief may be available on a future redemption, assuming all the qualifying conditions continue to be met. So this would mean a lower rate of tax rather than opting for the qualifying corporate bond. Additionally, if there is any doubt that the loan notes will not be redeemed in full, with non-QCBs, tax is paid only on the amount received, so a loss can be claimed if the full consideration is not received. Plus, also this election can be made to claim business asset disposal relief upfront. And unlike a QCB, where the entire gain is held over, so when the loan notes are redeemed, the whole gain will be subject to tax, whether or not the original value of the loan notes is redeemed. And one point to note is that where the vendor has taken QCBs and it transpires that the full amount may not be redeemed, the taxpayer can give the QCBs to charity to prevent the deferred gain coming into charge. So the issue of consideration is complex from a tax perspective, and it's definitely worth making sure you consider the tax costs and risks involved with deferred consideration and loan notes when structuring a transaction.
Thanks, Dawn. I'm conscious of time, and we do have a couple of questions. So I was going to do a couple of these now. Rod, for you, someone has asked, you mentioned aligning yourself with a potential buyer. How would you actually do this in practice?
Yeah, I think a good example, as I said earlier, is if you've got someone who you work with or you like to work with as a customer, that could potentially buy a business, then it's getting into some kind of commercial relationship with them, and it might be that there are active buyers out there. There's consolidation in a particular market, and it might be that you want to kind of maybe change the direction of your business to kind of align with these potential buyers. That takes time. So these are some of the kind of practical ways to align yourself.
Thank you. And April, what can be done to limit the exposure to the warranty claims?
Well, there are a number of things that we can do, and as I was saying, I think disclosure is by far and away the biggest part of the job, but we would certainly within the SPA itself look to add various caveats to time, financial limits on warranty claims, but we might also ask, for instance, the buyer to, for instance, make an insurance claim if that's a possible remedy for them before they make a claim under the warranties. or to exhaust any third-party claims that they might be able to make to recover their loss before darkening the door of the sellers. So really there are a lot of moving parts that we can put in to caveat and limit liability under the warranties and indemnities, but I think probably based on time, I'll limit my answer to that.
Okay,
but I'm happy to pick up offline.
And one final one that's just come in, deferred consideration. What is the most common method of payment? Is it sort of quarterly, yearly?
It can really be a combination of both of these. You know, it depends if the deferred consideration has been done using loan notes. You know, it can be quarterly. Probably in my experience, is probably yearly. It's usually the sort of deferred consideration phased over maybe a period of 3 years. But it really depends.
Thanks, Dawn. As I say, I'm very conscious of time. I just want to say thank you very much to all the participants for listening in today. We will be following up with an email with the recording. And if you do have any further questions, please do get in touch with us and we'll come back to you. And thanks once again to Rod, Dawn and April for a really interesting and thought-provoking conversation. Thank you all.